here today with Alastair George from Edison Investment Research. He's here to discuss his latest corporate strategy report entitled The Market Mirage. What does that mean?
Well, I think what it refers to is the way that central banks have been trying over the last 3 or 4 years to push asset prices to a place where it effectively stimulates the economy. Normally it works the other way around, that strong asset prices reflect a strong economy, and for this reason, because we've effectively got a very artificial level of interest rates, an artificially fixed bond market, and now we're starting to see a pretty substantial increase in the equity market, which isn't especially warranted by the improvements in the fundamentals. What I'm suggesting is that executives need to see through market prices and rely more on the fundamentals that they're seeing coming through their companies when it comes to making executive decisions.
We've seen markets become a lot more optimistic in recent months. What's your outlook for 2013?
My outlook hasn't really changed very much. I think we're going to see a good few years of sluggish growth, driven by the dynamics of an ageing population and the very large debt loads which developed markets have incurred while trying to fix the problems of the credit bubble of 2008. Where the good news is that the consensus for economic growth for 2013 has actually come down quite a long way over the last 6 months to maybe a 1.5% to 2% outlook for developed markets, and I think that's about right. But what I'm getting a little bit concerned about is we're seeing downgrades in the corporate sector. We're seeing earnings estimates coming down and markets going up. And to me, what that is, it doesn't reflect optimism about growth because investors can see the earnings numbers coming down. What it reflects is a lower cost of capital, and investors are having their arms twisted by central bank policy to push into riskier asset classes than they would otherwise have chosen, possibly, in order to obtain the returns which their investors demand. And this can, if growth slows down again, lead to quite poor outcomes. So I think the markets have run ahead of themselves a little.
Now, everyone wants to see the corporate sector invest more. Why aren't companies investing more, which would create real jobs and which could potentially really kickstart a recovery?
Well, I think you can look back over quite a long period of time. If you look at Western companies in terms of the capex to sales ratio declining over a 10-year period, which has accelerated post 2008, and with the opening up of emerging markets as a place where they could invest or source products where they would otherwise have had to have made investments within developed markets with a higher cost labour. You can see how there's a structural trend there, but it has accelerated over the last 3 or 4 years. And I think what you've got is a very rational corporate sector which learnt its lesson in the 1990s in terms of making overinvestments during the dot-com bubble, and is effectively deleveraged, was in an excellent position going into 2008, and is basically uncertain of the outlook for the future in the same way that I am, I think, and is only willing to invest where they can see a clear path to return on capital, and is looking for productivity gains, which is not necessarily consistent with hiring more workers.
But do you think they're being overcautious?
No, I think they're being. I know a lot of people would like them to invest, and I think that's an implicit objective of central bank policy, is to try and coax investment out of the corporate sector. But no, I think they're being entirely rational. I mean, you can see what's happened in Europe only in the last 18 months. A proper credit sovereign banking crisis, and they're probably looking at the way sovereign balance sheets are deteriorating, and thinking that we have a difficult banking system, we have an interesting outlook for sovereign governments, so let's hold back, let's keep our balance sheets in good shape, because either there could be opportunities or we could need that robustness within our business to survive a future downturn.
Do you think that there's a practical limit to the amount of quantitative easing that we've seen in recent years? And shouldn't that give companies the confidence to invest and execute mergers and acquisitions?
With quantitative easing, it's interesting when you look back at its original intent, which was to fix an acute problem in the economy. It's gone on for far longer than people originally anticipated. And what it's also becoming tied up with almost explicitly is the financing of government deficits. And so where you've had a very active central bank you've had less progress in terms of fixing structural deficits. And I think the limit is being approached not because the central banks don't want to do more quantitative easing, they would love to keep on going, but because the deterioration of the sovereign balance sheets. So, for example, with the G7, we're rapidly approaching a situation where the average net debt to GDP would be about 100%, and that's traditionally associated with a slower growth economy than a faster one.
And how have investors' needs shifted in this low interest rate environment?
Well, what institutional investors are desperate for is some kind of income for their portfolios. They've seen at the long end of the bond market, they've seen yields come down from historical levels of around about 5 or 6% down to as low as 1.5 or 2. And at the short end of the curve, you've seen interest rates taken well below, taken to zero, which is effectively a negative 2% real interest rate. And some of those investors are being coerced, arm twisted if you like, in order to meet their return expectations, of pushing out into riskier assets like equities. Now, for that kind of investor is saying to a corporate, I'm coming into your shareholder register as somebody who's looking for income. I'm not necessarily looking for capital growth. I'm not necessarily looking for high risk. So those businesses which can generate solid cash flows, which have a disciplined process for ensuring a good return on investment on their new investments, and can recognise that there's a new class of investor coming into their register, are likely to get a better rating than those who perhaps keep on increasing risk or pursue growth at any capital cost.
How have boards responded to this need for income in institutional portfolios?
It's about recognising this need and ensuring there's capital discipline within the company, prioritising dividend flows perhaps over capital expenditure, and certainly survey data is indicating even in the last quarter that is happening, that the returns to shareholders are being favoured over other investments. And we've also seen how M&A has been very muted over the last couple of years, and this again points to a capital discipline, and this is what shareholders want. This is exactly what executives should be doing in this kind of uncertain environment.
Alastair, thank you very much. And if you would require any more information, please do visit the Edison website.